Most of my clients are first-time home buyers, so that means they've never refinanced before. And I think overall in the United States, we've got about 32 to 34 trillion dollars in equity. The average American having around $300,000. Now, most first-time home buyers are nowhere near $300,000 in equity, but that money sitting there is something that I see a lot of online lenders, big banks go after. They're trying to take the equity from the homeowner and put it into their pocket. And one way they're doing that is through a refinance transaction. Because a lot of these people who purchased the home over the last couple of years are in a position where it may make sense for them to refinance, but they're unsure of how to do it, just like they were unsure how to go through the process when purchasing a home. So they're using that lack of knowledge to their advantage by overcharging for things. So one of the things that we do is we help educate our clients about the refinance process. This is a video that I sent to a client where we talked about the process, the cost, and when they should actually pull the trigger on a refinance. This particular client, we helped buy their home in Washington, D.C. They were first-time home buyers, and we used what's called a 2-1 temporary buy down. So their interest rate on the note was 30-year fixed, 7.125%. But they used a 2-1 buy down. So for the first year, they were only making payments as it were based on a 5.125% interest rate. The second year, it would have been the 6.125. And then years 3 through 30, the rate would be 7.125. So this is a video that I sent to them about the refinance. I did not want these banks and lenders taking advantage of their lack of knowledge about refinancing and overcharging these fees. And so this is a way for us to help educate. So check out this video. Hopefully you found it helpful. And if you have any questions, feel free to drop them in the comment. The purpose of this channel is to help you manage your mortgage and finance your real estate goals. So leave your comments, leave your questions, and I'll do my best to answer them for you. But check out the video and let
Hey
me know
there,
what you
it's
thought.
Tim, and I hope you're well. I wanted to include this video to walk you through the analysis that I put together for you. Refinance now or wait. As you know, you have a temporary buy down right now that you are still in the first year of, and that will last until January 2027. So I just wanted to kind of walk you through what it looks like to refinance now and compare that to a 30-year fixed versus a 15-year fixed mortgage. But before we do that, a couple things I just kind of want to point out. The Fed met yesterday, and as I'm sure you are aware, like many, they cut interest rates, but that doesn't mean mortgage rates got better. So this is an article that came out about 2 hours ago, and it kind of just breaks down what the Fed does and how it impacts mortgage rates. And as you can see here, people were hoping and expecting mortgage rates to fall after the Fed meeting yesterday, and that didn't happen. Rates actually went up. And why is that? Well, the Fed doesn't control mortgage rates. What they're doing is they're controlling the Fed's fund rate, which is the overnight rate that banks borrow money from each other. It has major impacts on monetary policies. But really, what ends up happening is it controls more short term interest rates like your credit card, your car loans, the 10-year. And mortgage rates typically follow the 10-year. And when they drop interest rates, that's great for the can be great for the economy, can be great for stocks, can be great for jobs because it means in the short term, borrowing money, spending money is a little bit better. However, in the long run, when the Fed cuts interest rates, that can actually cause inflation. And that is bad for long term interest rates like a 30-year fixed mortgage. Inflation is the arch enemy of mortgages. That's what we like to say, or we hear all the time in our industry. And as a result of the Fed cutting interest rates and what was said in the press conference following the Fed meeting about what they expect the future cuts to be this year and next year, that actually caused mortgage rates to go up a little bit. Now, I think this is kind of playing out very similar to last year. Last year, the Fed cut interest rates in September, and interest rates ended the year going up and breaking over 7%, which is the rate that you have today on your 30-year fixed mortgage is 7.125%. But you are in that temporary buy down, and that's very important to note. And I'll walk you through the numbers here in a second. So we don't really know what's going to happen with interest rates. We can monitor them for you. There is a forecast that comes out every month produced by the Mortgage Bankers Association. This one is back from August, and they're going to have an updated based on all the recent information, based on what the Fed said yesterday and the actions that they took. But if we go back to what we have right now, which is the August report, they are forecasting interest rates to slowly drop this year and to be stagnant next year in 2026. And I think that forecast might be a little improved, but it might play out similar just because of what the Fed said they're going to be doing during the press conference. They expect 2 more rate cuts this year, and next year 1 rate cut. And so you might see the market start to price in these rate cuts down the road. And what's going to end up happening is we're going to see how the Fed's actions of cutting interest rates impacts inflation. If inflation starts to go up, then mortgage rates are going to go up. If inflation remains steady, mortgage rates might slowly improve, but it's not a straight up and down path that rates are going to follow. There's going to be moments where rates are improving and hit new lows. There's going to be moments where rates go and hit, a 6-month, 12-month high. Just like any market, mortgage rates are traded on the secondary market, and investors will pull money in and out of the mortgage-backed security market, just depending on what's happening in the economy and around the world. So what we can do for you is we can establish a strike rate. This is your current mortgage, which again, you are in the first year of your 2-1 buydown. So your note rate is 7.125%, but right now you are making payments based on a 5.125% interest rate. And you'll continue to make those payments until January next year, where the rate will go up from 5.125 to 6.125. Okay. After your second year, then the rate goes to 7.125%. Okay. So with all of this being said, this is your mortgage. You're the one that's making the mortgage payments. You can tell me what you want to do. I'm just going to give you some information and give you my opinion. Right now, your mortgage payment is around $51.43. Okay. And if you were to refinance today, your interest rate would be around 6.5%. And that would cause your mortgage payment from what you are currently paying to go up by about $503 per month. And you would have to pay for the refinance. There's closing costs, prepaids, and escrows to do that. So my train of thought goes to, why would I go through a refinance only to have my mortgage payment increase? And again, if we think interest rates are going to break past 7.125, your current note rate, then absolutely, maybe we're going to go ahead and lock in the lower interest rate so that you're protected, well past the second year. Because as you can see in this analysis, the interest paid 9 years down the road is a lot less than what you are going to pay if you stuck with your current mortgage. You'd be paying around $481,000 in interest and mortgage insurance versus $438,000 if you were to refinance at today's interest rate. So again, you can tell me what you want to do. I also included a 15-year fixed option for a refinance now. If you were to move forward on that, that would cause your mortgage payment to go up by almost $2,100 a month. And again, there are closing costs for that. But if you look at the total interest that you're going to end up paying, it's a lot less. We go about $320,000 from $481,000, so $160,000 that you're going to save in interest and mortgage insurance over the next 9 years by refinancing to a 15-year, but that comes at a cost of around $2,100 per month. Again, you can tell me what you want to do, or what we can do, and we've been doing this for a couple of our clients, is we've been establishing a strike rate. What that is, it's going to monitor your scenario and price it out every day. And if we hit our strike rate, it's going to notify us. And if at that time it makes sense and we want to move forward with the refinance, we can certainly get that done. So it's a way of kind of just setting the alarm and waiting for it to hit. So in this analysis, what I've done is I have the 30-year fixed improving by 1% to 6.125%, and the 15-year dropping to 5.375. If that were to happen, compared to what you are currently paying right now, your monthly payment would go up about $313 with the 30-year fixed. With the 15-year, it would go up by $1930. So I don't know if you want to refinance now to give up the temporary buy down. Again, you can tell me if that's what you want to do, but what we can do is monitor interest rates and just see how things play out over the next couple weeks, months, or even all of 2026. If for some reason we want to act quickly, we can certainly do that. A couple other household items with this analysis: you can click on more info, and it will show you a breakdown of the monthly payment. We are using the taxes and the insurance based off of what you were paying when you purchased the property. So this is the total housing payment that you're seeing based on the terms of the interest rate. You can click on the closing costs, and you'll see those summed here. And then if you click fee detail, everything is itemized. With a refinance, you have closing costs, and you also have prepaids and escrows. So we show the cash to close being around $10,000 across the board, but that comes with about $4,000 of your escrow for your escrow account. What ends up happening is your current escrow account in your house when your loan gets paid off, that account gets closed, and whatever the balance is in the escrow account at the time that they receive the payoff, you're going to be receiving a check in the mail. Usually takes around 30 days. And that most likely is going to be a wash from what we show, or be very close to a wash from what we show being collected in the prepaid. So the actual cost of refinancing a loan your size in Washington, D.C. is going to be right around, we'll just call it $6,000. Okay. And that includes lender fees, that includes settlement fees, title, taxes, what have you. Okay. Now, with the closing costs, there's many different ways you can pay them. Right here in this analysis, I show you bringing them to the closing, but you own the equity since you now own the house. So you can roll those closing costs, prepaids, and escrows into the loan, increasing it from what you currently have, and not bring any money to the closing. A lot of people refinance that way, or a lot of people will just roll in the $6,000 in closing costs, and they'll bring the prepaids and escrows to settlement, knowing that they're going to get a check, and it should result in a wash with the cash they brought to close. We can walk through all the different ways you can pay for your closing costs when the time comes, and determine which strategy makes the most sense for you. Right now, the purpose of this is to establish what it looks like to refinance now versus setting a strike rate. And with interest rates, they're going to be advertised and talked about from now until the end of time. Just understand the interest rates that you see is not always the interest rates that you will get. There are something called loan level pricing adjustments, and this is not an Atlantic Coast mortgage or a bank or lender thing. This is created by the GSEs, Fannie and Freddie, and there are different variables that can cause your interest rate to be different than what you see advertised. Typically, you're going to see banks and lenders advertise the best case scenario. So assuming a great credit score, great loan to value ratio, and there's no adjustments to the interest rate. But when you refinance a home, you have loan level pricing adjustments. You have costs based on the risk, and the risk is determined by Fannie and Freddie, and those costs are added to the price of the loan. So usually that means that you end up paying discount points to get the rate to match whatever the great rate that you saw advertised, or those points are rolled into the interest rate, and the interest rate comes out to be a little bit higher. So you might see interest rates advertised in the low 6% range, and I've quoted 6.49%. Just understand that's because it's taking into account all of those loan level pricing adjustments based off of your qualifications, your property type, where it's located, the loan to value ratio, and all the details that matter. So we will set a strike rate if you want to, based on all that information, and it will monitor it and price it out every single day. And if we hit that rate, we can have a discussion and see if now is the right time to pull the trigger and get moving on this refinance. But in my opinion, I would probably suggest waiting, being a little bit more patient, because you are in the 2-1 buy down, to see what happens over the next couple of weeks, next couple of months. Hopefully the forecast that we saw from the Mortgage Bankers Association plays out. Interest rates kind of just move sideways, maybe get a little bit lower than where we currently are. And we can get you refinanced at any point over the next, we've got, 15 months or so before your rate will adjust to the 7.125%. If you have any questions, feel free to reach out to me. I hope all is well, and have a great day.
So if you found this video helpful, check out some of these other videos. The algorithm says you might like them, so check them out. And if you do, please subscribe. I'm trying to grow this channel in 2026. The goal is to get up to 500 subscribers. We're less than 200 away. So if you just hit subscribe and let me know what you want to see on this channel, I'll be sure to do that for you in the future. Appreciate it.